Good evening, VV Nation. My name is Ryan. Welcome to the channel. Big Thursday. We just kicked off the Roadshow event earlier today. So, forewarning, today's video is pre-recorded. However, we are going to do one of my favorite installments, and that's going to be taking it back to the basics, right? I know all of the tariff turmoil, all the news in the market, sometimes we forget about the basics, and the basics is what really keeps you on the right side of the market. So tonight's presentation, I'm going to do moving averages, right? And there's three ways, that's right, three key ways to really utilize moving averages to keep yourself on the right side of the trade. So if this is something that you're interested in, stick around and let's get started. Now, before we get into the software, most people are familiar with what simple moving averages are, right? SMAs. Now, in tonight's presentation, I'm going to utilize EMAs. I know there's a lot of question. What's the difference between a weighted moving average, a WMA, and an exponential moving average? Well, with simple moving averages, all of the data points, say if we're looking at a 10-day moving average, all 10 data points are weighted equally, right? While weighted moving averages hold more weight to the most recent data points. And when it comes to EMAs or exponential moving averages, that weight is carried exponentially closer to the data points. So me personally, I typically use either SMAs or an EMA for most of my charting. Now let's jump into the VectorVest 7 software and show you the three ways to effectively utilize moving averages. Now, the first method is comparing a moving average to price directly. Now, for this example, I've got the Qs up. You can see my date line here back on May 8th, 2024, you see price action breaking above this 40-day moving average. Typically when that does, usually you can get a nice rally out of it, right? We can see the cross below that moving average occurred several months later, back on July 24th, price action breaking below that moving average, showing that the bears are back in charge. Now, this is a very simple method. As long as price action stays above that 40-day moving average, and sometimes a lot of investors and myself utilize a 20-day EMA instead of the 40. Those would probably be your two most popular to do this type of strategy with. But you can see, very good examples here with this position. Another good time to be bullish when price action went back above that 40-day moving average in September. That party lasted up until the beginning of the year, and you can see right when price action clear break of this 40-day moving average back in February and diverging away from this moving average to the downside. A good time to be defensive with existing positions or get bearish utilizing contra ETFs, option strategies, things of that nature. So again, very simple yet effective way to utilize one moving average compared to price action. For my second example, we are going to utilize meta platforms for the chart. Now for this example and the second strategy utilizing moving averages, the first one we compared one moving average to price action. This one we're actually just compared two moving averages to give us a sense who's in control, the bulls or the bears, right? Now we can see the first half of this chart before the high here. The 3 remained above the 8 for the most part, and we see the bulls in charge, right? We got the high coming in, a lot of buy recommendations in place, good time to be bullish. However, now over the last few months, the 3 remains below the 8-day EMA or exponential moving average. Now you can utilize other moving averages, kind of a rule of thumb. The smaller the numbers, the more active of a trader you are, right? So for 3 and 8, it's probably from day trading to swing trading, a couple days, maybe a week or two, depending on the momentum of the stock. Now, if you're a longer term trader, you could do something like the 50-day and 200-day moving average to give you a better sense of the long-term trend of a position, and if it's still a good idea to be bullish or bearish on that position. For my last example, to be more effective when utilizing moving averages, this is an interesting one. For the example here, I've got a 200-day moving average. The reason why? Moving averages can be seen as a level of support and resistance, right? And you can place your trades or place your trading strategies according to what you see on the chart. For example here, right? PayPal clearly in a downtrend. We've got one touch on the 200-day, clear rejection. Another touch on the 200-day, clear rejection once again. So you're seeing that level of resistance occur. However, we do see some consolidation around this 200-day, several touches as a level support here. Again, another retest from the downside. However, when the bulls did finally take charge, broke above that 200-day moving average and was off to the races. But the important thing here to note is look at the pivots on a lot of these swings of price action, right? They occur on the 200-day moving average. And a great example in today's time would be utilizing the 200-day moving average to see what the market can get its act together. Now here's the Qs, almost 3 years of data, 2.5 years. We could see the price action of the Qs below the 200-day moving average. Nice break, retest on the moving average, again, just like a support resistance. And as the bulls take charge, look where the retest occur, right? Right at that 200-day moving average. So again, when you see the price action of an entity or the market at the 200-day moving average, probably, a good time to put it on your radar. Might be some good buying opportunities. However, sometimes when the market is selling off, you can see that 200-day moving average was a little bit of a support here, some consolidation, a couple candlesticks here. Nice retest on that 200-day moving average, giving me optimism for the bears here. You can see the bearish momentum coming into place, but as long as the Qs remains below that 200-day moving average, typically investors and traders are going to be bearish on that position. So going forward, we'd like to see not a retest, not a rejection at the 200-day moving average, but a clear break, maybe a retest from the top side, and then off to the races. That would be the best bull case scenario when looking at the 200-day moving average and the NASDAQ 100. All right, everybody. Hope you found this video very straight to the point, give you some tools in your tool belt so that we can be more successful in the market going forward. Now, I hope everyone enjoyed tonight's presentation and more importantly, enjoyed today's roadshow. Have a good night and I'll see you next week.